Scott Hayes from ISC Group. I wanted to talk with you a little bit today. It's now July, so we have half of 2025 is already in the rearview mirror. A lot has happened, of course, in the first half of the year. I want to talk a little bit about that, what we anticipate might happen for the remainder of the year, and also talk about the news of the day, which is the big beautiful bill, or the one big beautiful bill that is now the law of the land, signed into law by President Trump on July the 4th. And so with that, let's go. I'm going to talk first of all about federal finances. One part of the criticism of the one big beautiful bill is that we can't afford it. We have $36 trillion in debt as a country. We're running 7% deficits, and we're not even in a recessionary period. And at some point, the amount and the burden of that debt is going to be problematic. And you're already starting to see it here on the left-hand side of this chart. We have the interest payments on the debt currently exceed all the spending on the military. So there's no doubt that we're borrowing from future generations to fund these deficits today. So when we look at the one big beautiful bill and its impact on that debt and deficit, it does look like it's going to add to that, but not as much as had been previously forecasted in prior iterations of this report. If you look at the upper right-hand side of the chart, this is from the Congressional Budget Office, which is a nonpartisan entity that scores budgets and their impact on the debt and deficit. And so this is based on the Senate's version of one big beautiful bill, but the final version was fairly tightly correlated with this, so the red line shouldn't change that much. But the red bars are the incremental impact of the bill and what that means to the debt and deficit over the following 10 years. So they're lower than they were. I think I may have shown the same chart in a prior webcast. But why is that? Well, one, some of the tax cuts, which include no tax on tips or overtime, which are all over the news. There's no tax on, or I'm sorry, you're going to be able to write off your interest on auto loans. That's new, as long as the car was made in America. And those tax cuts are going to expire at the end of 2028. So you get 4 years of spending cuts supported by 10 years of tax cuts. And so that has a bit of an improvement on what they were forecasting before. Of course, 4 years from now, is it likely that they're going to extend those and roll them over and say, we can't cut these? Yeah, probably. That's the way that it historically happens. But anyway, according to this current forecast, that's the impact of that. We are also starting to get additional revenues from the tariffs that were implemented on Liberation Day back in April. Even today, President Trump is negotiating with our Asian partners, his most recent thing, and they now have until 8/1 to come up with, to get to the negotiating table to make a deal. But anyway, just the numbers on that. Back in March, we were receiving about $8 billion in tariff revenue that month. That was up to $27 billion in June. And so we are actually receiving additional tariff revenue. And 60% of the cost of tariffs is estimated that are going to be borne by the consumer. So eventually some of that's going to come down in the inflation numbers. And it should be a drag on growth, frankly, because consumers are going to cut spending at some point to offset the impact of that. But we are going to have a boost in the first half of 2026 in spending because of the fact that the tax cuts were implemented effective January 1, 2025. So what's likely to happen is that if you suddenly have income that's not subject to tax, you're likely to get a refund in 2026. And so that refund will be a boost, extra money that the consumer will have to spend money, which should offset the impact of tariffs in the first half of the year. After that, it's a one-time deal. You spent your refund check, and then, we might see an overhang again from the tariffs after that. So let me talk a little bit about the tariffs in a little bit more detail here, because that is a big thing on most people's minds that I talk to. So the numbers are down from Liberation Day, but they're still substantial. We were talking about back at the peak, upwards of 30%. It looks like now we're probably going to settle in the range of somewhere around 15%. which is still exceptionally high compared to where we've been since the Smoot-Hawley tariff days back right before the Great Depression happened. So as it stands, with Liberation Day in April, so anything put on a boat in April from China may have arrived in May. So we've just started to see those goods being taxed with the new tariff data. So in April, our friends at JP Morgan say that 5.2% of goods that were imported in May had this excess tariff on them. In May, that was 8%. So it's not surprising that we don't really see the impact of these yet in the inflation data. And plus, on top of that, a lot of demand was accelerated. Remember, especially with the auto tariff idea, a lot of people went out and they bought cars ahead of the projected date of that. So a lot of demand has been pulled forward into the first half of 2025. And so they've already bought cars, so we expect things like that may slow down future purchases for the remainder of the year, which should have a cooling effect on the economy too. So, there are still some uncertainty around it, but around 15% is where we'll probably be. But what that does is it does cause a lot of uncertainty for like interest rate policy in the Fed, and what that means is should they cut or should they leave rates where they are. And on that topic, expectations have shifted. This is the dot plot, the famous where what the Fed thinks, they poll all the governors and they say, what do you think rates will be next quarter and the quarter after that and long term? And then that's going to be your blue line there. And then the market expectations are in green. So the market's expecting more cuts than the Fed is forecasting. But all of those numbers are down from what they were forecasting at the beginning of the year. And, really that's just because this is kind of unprecedented. The Fed wasn't around last time the tariffs were this high. So really, they just frankly have to wait and see what the impact is of the tariffs on future growth and inflation rates. Will they be bad? Will they not be bad? Who knows? At the end of the day, Chairman Powell's term is up this summer, and there's a whole lot of talk around who the replacement will be that will be appointed by President Trump. It'll be somebody likely that will toe the line, or at least say they'll toe the line on his demand to lower interest rates. He's been a big proponent of that. So we'll see, but that's when rates are likely to probably be cut more, is after Chairman Powell is gone. We don't think it's likely they're going to cut in July. Maybe in September, once the new Fed chair is installed. We'll just have to see, wait and see, right? So let's talk about what's happened here with returns. So despite all the uncertainty we had, stocks went down 19% after the Liberation Day announcement. They ended up, if you look at the large cap number there, 6.2% on the year, right in the middle. So had a nice rebound from that bottom. Cash, despite all the uncertainty, a lot of people say, well, I should just go to cash and wait this thing out. That was one of the worst performers, making 2.1% year to date. So if you have short-term needs for the money, that's a fine place to hang out. But if you have a 30-year time horizon, cash can be a really dangerous place to stay over time. So stocks were up 6.2%. What I'd really like to point out here is the top performing categories, both international and emerging markets, they collectively had about 1,200 basis points of outperformance over the U.S. stock market. So I'll show another chart about that here momentarily, but the U.S. dollar was down 10% during the year, first half of the year. So that's a tailwind for international stocks. But what this shows is a diversification. We always preach diversification, but it's finally worked again for the first time in the last 3 years. So those clients that have money and the models that allocate not only domestic, not only stocks, but also bonds, but international, that has paid off so far this year. So looking at global equity performance and outperformance, underperformance, what this chart shows is anything below the line is when U.S. stocks have outperformed, and above that line, the purple graphs there, that's when international stocks have outperformed. So we have a long line here, a long time where U.S. equities have been, U.S. exceptionalism has prevailed, and market returns have followed. So what I'll highlight here, though, is that one, U.S. stocks are trading at a premium of about 35% to international stocks, which is double the normal. So, there's room to revert on that. Plus, about 64% of global equities are now U.S. equities, which is an all-time high. It's normally more 50-50ish, whatever. Foreign ownership of U.S. equities is an all-time high. But then you see on here the gray bars. Those are periods in which the U.S. dollar has been falling, and that is a period now that we're in. Like I said a moment ago, we're down at about 10% this year to date. That should probably continue. May pop some, who knows, but it looks like that could be a longer-term trend. We'll wait and see. Moving on, I've shown this slide before. So even though we're at 6%, well, so it shows 5 on this chart, but we have had a 19% drawdown this year so far, which is perfectly normal. You see in the title there, again, this is from our friends at JP Morgan, despite an average intra-year decline of 14.1%, stocks have gone up the last 34 out of 45 years. So over very long periods of time, the stock line chart, does go up and to the right. Has historically anyway. There's no guarantees, obviously, for the future, but that's if your holding period is infinity, stocks have been a good place to hang out. So the market is pricey right now. I've shown this before. This is a dispersion chart showing a regression line of future returns based on where the U.S. market is. And over 1 year, it looks like a kind of a shotgun. There's not a high correlation between price and returns, but over a 5-year period, which is the chart on the right, there is a pretty tight regression, meaning that the cheaper it is, the better the performance is looking forward. The more expensive the market is, the further to the right it is by the price-earnings ratio, the lower the forward-looking return is. And so we're still in that. Well, by both charts, you see the red diamond on there, indicates that we might have single-digit type returns going forward just based on the price alone here in the United States. There is a lot of dispersion between the most expensive stocks and the cheapest stocks. You see that the green line is the average, the median price-earnings ratio on an S&P 500 stock, but the width of that gray bar indicates the range of expensiveness. So some stocks are very super expensive, some are relatively cheap, and so we think that should bode well for active money managers who look for value stocks, things that are maybe underappreciated right now with some kind of a catalyst to turn that around and grow or be more rightly priced, going forward. So there's always somewhere that you can make money in a market, and that has widened a lot from recent days. So that's good. Again, here's just a look at global valuations. We see that the gray bar, the width of that, or the height of that, is the range over the last, I believe it's 10 years. Then the blue diamond is where we're at currently. So looking at the U.S. on the left-hand side there, we're trading at the upper end of the range of historic expensiveness. And that's not the same everywhere. Japan looks super cheap. China looks cheap, although you can question how investable that is or not. But point is that international equities do appear to be more reasonably priced than here at home. Fixed income yields, same way. I think we've seen some normalization of yields. The blue diamonds are still near the top of the range, but we think if you just are able to clip a coupon today, and in corporates, for example, earning 6.3%, even if you don't get any forward, any additional increase in the prices there, fixed income still is a relatively good place to hang out. So we like that. And then I'm going to end with this. So when you look at the components of GDP, which is gross domestic product, that's what we consider growth, right? What is the growth rate in America? When you hear that term, we're talking about GDP or economic growth. And so you see here the average over the last 5 years is 2.2%, but the inputs to GDP are growth in workers and the growth in real output per worker. Another word for real output per worker is productivity. So we're getting a bit of a squeeze in terms of the growth in workers right now with all of the immigration policy, and we need to have a sensible immigration policy, but we're working on that. But so the growth in workers is being there's a little bit of a friction there. But what I really think could be our saving grace over the long run and the answer to the debt and the deficit is the productivity. We're on the very beginning of an AI revolution that's going to make, depending on your job, a lot of us a whole lot more productive, meaning you can get a whole lot done with less people or without having to hire a whole bunch more people. So that's productivity. So that side and that half of the GDP equation could lead to fairly significant growth over the long run. And if you can, there's a potential to grow our way out of this. If we can grow faster than the debt is rising, then the debt burden becomes less as a percentage of that overall wealth. So, I hope that we'll address it as a nation at some point. Everybody likes paying less tax when you can, but we do have to get our fiscal house in order at some point in time. We think that there's really nothing on the horizon other than some kind of an exogenous event that you can't anticipate, that we should have a meaningful recession in the next year or so. Nobody knows. You can't predict what the market's going to do, of course, but as I showed on a previous slide, we do recommend that you invest for the long run and stay the course. If you do have any questions or concerns, I'd encourage you to contact your ISC representative. We're more than happy to walk you through it and make any changes as might be appropriate for you and your family. With that, I'm going to wrap up, and thank you for watching this, and talk to you soon.